What's up, guys? It is Sterling here from Day Trading Forex Live, and as the title of this video shows, a simple Forex day trading strategy for tracking market manipulation, for trading with that manipulation, and then for putting us in line with smart money, which is the whole goal of what we're doing here. In the previous video, if you guys watched that, we covered the selection of manipulation points, just the process of, number one, identifying where smart money, and when I use the term smart money, I'm referring to the largest market participants in the Forex market. So in the very first video, I think it was the second video, where we discussed reactive versus predictive trading strategies and how 95% of trading strategies fall into that reactive category. It's important to understand that as we kind of broke down the basics of how smart money trades. Because when you think about how smart money trades, how they have to trade, we covered a basic point that 10 banks control 60% of the daily Forex market volume. So that's number one. I guess if I had to kind of summarize this in a better way, 10 banks control 60% plus of the daily Forex market volume. Now, that's not them speculatively buying and selling. Some of it might be, but the vast majority of that is smart money, or the banks, I should say, simply filling orders. They're for global trade, for global trade, worldwide commerce, obviously speculation, insurance companies, hedging against physical. I mean, the list could go on and on. But the main point is that they have to process the majority of the volume during the day. So the one thing you're going to know is that if you had to process 60% of the daily volume, obviously it's not all getting processed at once, because you just simply can't do that. All the liquidity is not there at one specific price point. So knowing that they control such a huge chunk of volume means that when they control that huge chunk, they're going to search out areas of liquidity. They're going to search out areas where the rest of the market is likely buying, or the rest of the market is likely selling, or just simple rollover occurring at a specific point. And this testing back and forth between levels, it's something that happens in all markets. I mean, I've been doing this, the confirming entry. Some of my first videos on market manipulation on YouTube go all the way back to like March of 2010. I've been doing this for damn near the better part of a decade, and it consistently stays the same. It stays the same because this is basic market function we're covering. The people that control the market have a crap ton of volume. Because they have a crap ton of volume they have to process, they need to find buyers if they want to sell. They need to find sellers if they want to buy. That's why we discuss the selection of manipulation points on where that volume might be. Because if you know where the volume is, or where it's likely to be sitting, I shouldn't say no, because in trading, knowing is a very relative term. But if you know with a good idea, or a higher probability, better than 50-50, where that volume is sitting, now you can start to develop an edge off that. Because if you know where the volume is, you know where they're likely going to go. If they want to reverse the price down, they're likely taking out an upper level first before the price drives down. If they're coming into and they want to drive the market up, they're likely going to come into a lower level, take out any liquidity below that point before driving the market back to the upside. So that was the second video. I think that was the third video, actually, we covered on the selection of manipulation points. And as I mentioned in that video, the next one that we're going to cover is the confirming entry. I'm just going to check, make sure we got any questions coming in, guys. Let me know. I am still going to look at the chat and cover that as we go. But let's go ahead and get into the confirming entry. And basically, this is the next step. You identified the manipulation point, so you need to have a way of actually triggering the entry. What's telling you that you should get into the market? That's what this is all about. So identify the manipulation point. We've already covered that. That's number one that you're going to be doing, for getting a setup according to these rules. Identifying where they're likely to create this stop run. But we don't just blindly enter the market. We need this confirming entry, and that's why we have this as number two. Confirming entry, that's actually what's triggering the entry and giving it to us. Let's go over to the next high-tech slide here, and number one, I'm going to start with the rules. If you guys want to write this down, I would highly encourage you to write it down, ask questions where you have them, and let me know if anything pops up that I don't cover in this video that you have a question on. So number one, we've identified the manipulation point. So I've wrote down manipulation point there. I'm not going, it could be whatever level it is on whatever pair you happen to be trading. But number one, we've identified the manipulation point. So that's obviously number one. Number one the first thing we look for as far as the actual entry after identifying the manipulation point is we look for at least a 3-pip break of the level. Now, this is somewhat relative. I use 3 pips around 100 pip average daily range. So if you're dealing with, say, the pound yen, it gets up to a 200, 250 pip average daily range. A better way to phrase that might be a 3% of the ADR break, depending on the pairs you guys use. And also that will allow you to go to whatever market you want to trade, because a percentage of the ADR is pretty universal. Why do I look for a 3-pip break? Well, I'm looking for a 3-pip break because I want to see the market testing beyond the area of liquidity that I've identified. I want to see it testing beyond that. And then the most important factor of this whole process is the rejection back away. That rejection back away is us getting an indication that when smart money stepped into what I term as kind of the stop run zone. So basically, I'll just do SR. I'm terming that as the stop run zone. So what I'm saying is, as they're stepping into that zone, if they are selling into whatever buying pressure is occurring, people buying on a breakout, short traders getting stopped out, having to buy the position back, whatever it might be, when they step into that level with the 3-pip break, that is the first thing I want to see, because I want to see them testing that. I want to see them sweating the short traders and see if they're inducing that buying pressure. I want to see them triggering the breakout traders. By getting the break of that level, you're just getting a little more confidence that you've seen the false push. You've seen the identification of the manipulation move around that level. So that's obviously number one, is just the 3-pip break. A 3-pip break does not initiate that trade. What we then need to see is what we term as our confirming entry. Our confirming candle, which is where the confirming entry gets its name, obviously. So what is a confirming candle? Well, a confirming candle has 2 very basic rules. There's nothing complex about this. In my, close to 14, 15 years of trading, 11 and a half of that or so as a full-time trader, this part to me on simplicity is just absolutely critical, because simplicity leads to repeatability. And you don't get rich in this market in a month, 6 months, even a year. It's going to take you multiple years to grow an account. If you don't have consistency, you might as well pack it up or start working on that, because that's the key. So simplicity, or creating that repetition, comes from the simplicity. And that's where these rules are. That's what these rules are based in. That's why I only see 3 rules here. 1 rule for what the stop run actually is to even start this process. But then number 2 is the confirming candle. It has 2 rules. Number 1, and I'm talking about a short here, obviously. Number 1, it has to close in its lower 1/3. What you're doing there is you're measuring from here to here. That's the entire spread of the candle. And you're measuring it, does it close in its lower 1/3? So, this would be a third here, then you have another third here, then you have your upper third here. So this is the lower third. And it could have closed anywhere within that to have satisfied that specific part of the rule set. The other aspect to that is it has to close below the body of the previous candle. Now, I shouldn't have wrote candle body, but close below the previous candle. I guess I should say candle body. Close below the previous candle body. So does this close in its lower third? And does it also close below the body of the previous candle? Well, you can see it very clearly does. Now, here's a little bit different setup. It's what a lot of people would term as a pin bar. I really don't care how that looks. I'm looking for one thing to initiate the stop run. Does it break? Does that one rule, does that break by 3 pips? That's our first rule. Does it break by 3 pips? If you break by 3 pips, I couldn't care less how it looks, what that candle looks like, whether it's a wick, ends up being a wick through the level, or the body. Does not matter to me in that situation. So that's number 1. Number 2, getting that confirmation, closing below the body of the previous candle, number 1. And then also, does it close in its lower 1/3? Does that close in its lower 1/3? Well, I think it's pretty straightforward that that does close in its lower 1/3. So a way you could invalidate that is do something like that. Let's make it even more obvious. Now does it close in its lower 1/3? Well, no, you'd say that's probably, somewhere around the halfway point, right? So what you're going to do is the majority of the time that's going to be very obvious, whether it is closing in the lower 1/3 or whether it's not. If it's not, measure the entire spread. So mark your high, get your exact high, get your exact low, measure that distance, whatever it is, take it to your calculator, divide by 3, that'll give you a third. Does it close in the lower 1/3? That's what you're asking. Now we're walking through more examples of this, and I'm going to go to the computer and I'm actually going to show you some live examples of recent trades that we had set up here in a minute, but let's see. So let's go to the second page here. And we'll walk through the entry a little bit more in identifying this whole process. We're talking about stop loss placement now. So with stop loss placement, what you're going to look at is you've got your stop run of the level. You've broken by 3 pips. Your following candle is confirmed down. It closed in its lower 1/3, and it also closed below the body of the previous candle, thus validating what we term as a confirming entry. Now, when the confirming entry is validated, the next step you need is actually taking the entry. We're waiting for the close of this candle, so when the next candle opens is where you're taking the entry technically. When that next candle opens, the only thing that you need to decide or you need to determine, would be the better way to phrase that, because your decision process at that time is already done. Has it followed the rules? It either has or it hasn't for a confirming candle, a confirming entry setup. Now the next thing you need is you need to put yourself in a situation where you can have a proper reward to risk ratio. A proper reward to risk ratio starts with having a good stop. If you have a 50 pip stop loss in an average daily range market that only moves 50 pips, well, trying to even get to 1-to-1 is going to be rather difficult. I want to always look for 2-to-1. That's what I always look for when it comes to setting a take profit. You'll see down here, take profit, 2-to-1 reward to risk ratio. Again, simplicity, keeping it simple. 2-to-1 on the reward to risk ratio. So the take profit's pretty simple, but you got to shrink the stop size down to be able to have a take profit that is what I prefer it to be, which is 40 to 55% of the ADR. A rough rule of thumb, or general rule of thumb here, 50% of the ADR for the take profit, or maybe a touch above it, but not much. That's a good rough figure that I've used, in my decade plus of full-time trading, that's what I've consistently used. So that starts with first identifying your stop size though, because you're doubling it for your take profit. In a normal market, what I look for is if my take profit is 40 to 55% of the ADR, then what I want, if my stop loss is going to be half of that, then I would have a stop loss that is 20 to 27.5% of the ADR. That's half of the 40 to 55% range. So in this situation here, as a percentage of the ADR, that's kind of how you can figure it out. Your stop loss somewhere around 20 to 27.5, 25% of the ADR if you want to make the math simple. So in this case here, that is, that's kind of on your max side. But as a general rule, we use a 20 pip stop. That's kind of how we keep things simple. If the ADR is below 100 pips, we use a 20 pip stop for the majority. I'm not going to get into the dynamic stop here. I'm not going to get into all those other aspects because this could be a 5-hour video. But I'm walking through the basics here. So let's walk through an example based on a 20 pip stop and illustrate how that process works. Now in this example, the confirming candle closes at one spot 1990, right? We close at one spot 1990, and the manipulation point, that's what this dotted red line is. You can see I have that listed at one spot 2000 just for reference. But I have the high listed at one spot 2020. So if you took the entry right here at one spot 1919 and you placed a 20 pip stop, your stop would be at 2010. That would be well below the high of that stop run. The goal of this is to get our stop loss. In the case of a short, it's going to end up being 5 pips above the high. And we're going to walk through why that is exactly. But the point being is we want to get that stop beyond the high. If this is the stop run, if this is the manipulation move, then the theory behind why I want to get beyond that high is that that was the stop run. That was the move that was designed as the trapping move, the false move. So if I've truly got it right, that becomes a very safe location. Just putting your stop above a high or below a low is kind of a dangerous thing to do because of this. They're typically going to come for those previous highs. That's why that's almost one of the worst places you can put it, unless it's the stop run. If it's the stop run, well, then you've already seen the stop run. It's cost inhibitive for them to come back, take out that level again. It doesn't make a whole lot of sense. If they've already taken out that level and induced the liquidity, they're likely not going for that high again. If they are, you're probably going to be wrong on that setup. So in this case here, if we're using a 20 pip stop and I want to get 5 pips beyond the high, it's pretty basic math here. I got to take the entry at one spot 20.05. If I add 20 pips to that, that gives me one spot 20.25, which is 5 pips above the high. So I'm taking the entry to kind of simplify this is get your high, subtract 15 pips from that. That's where your entry is because your stop's going to be 5 pips above the high. Get the high, subtract 5 pips, that's where the entry is. Now in this case here, what that would require is that requires taking the entry when the market looks like this, right? So the market looks really bullish at that point, and it's right when you go, man, this is super uncomfortable. I don't want to take this entry. It's a bullish candle. You know, we've rallied 15 pips now. I'm staring down a completely bullish candle. That's exactly when you want to be taking the entry. You know, at this point, how has comfort benefited you? You've taken entries that are comfortable to you. You've taken entries that make sense. You know, it's in line with the trend. It's a retracement. It's this or it's that. They felt comfortable to you. And you've had poor results with that. If you're taking entries where you're comfortable or it looks like it's headed in that direction, you're probably making a sacrifice on some way or another, whether it's the actual entry, the stop size, whatever it might be. But in this case here, that's exactly what you want to feel. You want to feel discomfort when you're taking that entry. That discomfort is what gives you your good reward to risk ratio, because it just shrunk this stop from having to be a 35 pip stop. If we pulled the trigger right there, 35 pips if we want to get it above the high, well, that's a completely different dynamic. 35 pip stop, you want a 2-to-1 take profit, that's a 70 pip take profit. Right now, that's damn near not quite 2 times the ADR on the euro, but it's 1.5 times. It would be a very significant move. So that's why the pullback is there. The pullback is there solely for reward to risk ratio. There's nothing about this, the pullback aspect of this, that is designed for anything other than to optimize our reward to risk ratios by shrinking our stop loss. All right, let's see what else here. Take profit, 2-to-1, we've covered that. If you're dealing with a 20 pip stop, 40 pip take profit from where that entry is. And again, don't overcomplicate the process, guys. I did a video on 4 rules of, I don't know, beginner rules to success. Point is, the video covers 4 very important rules. And in that video, I talk about if somebody took 12 trades a month, 2% risk per trade, only won 50% of their trades, and did so on a 2-to-1 reward to risk ratio, that equals roughly about a 9% profit at the end of the month. Based on those figures, 12 trades a month, you only win 50% of them, means 6 winners, 6 losers, and a 2-to-1 reward to risk ratio on that with 2% risk per trade. It means your winners, you're gonna make 4%, your losers, you're gonna lose 2%. But that video walks through how this type of reward to risk ratio on a relatively, what most people would consider a low hit rate, grows an account so rapidly over the course of 2, 3, 4 years. I mean, at the end of 3 years at 10K at 10% a month is a little over 275,000. 10K at 10% a month for 4 years is just shy of $1 million. I'm not saying that you should expect to hit that number. I'm just quoting basic math here. And that basic math illustrates that compounding is key. And this is a huge part of compounding to me, because in trading and in my experience, the best traders in the world win about 50% of their trades. That's the entire secret to trading. That's why every BS marketer you see, they're going to advertise to you with win-loss ratios. That's the greatest way to tell if a trader's a profitable trader. If he talks about win-loss ratios, he or she talks about win-loss ratios over reward to risk ratios, there's one trader I know that doesn't run a really high reward to risk. Literally one that's profitable. So I'm not saying you can't do it. I'm just saying this is, in my experience, by far, by a magnitude of 100, going to be a hell of a lot easier to be profitable at a 50-50 hit rate with a 2-to-1 reward to risk ratio. And not only is that super profitable, but it's actually more profitable than somebody that wins 70% of their trades with a 1-to-1 reward to risk ratio. Do the math on that sometime if you haven't. Okay, candle count. That's where we're going to get a little complex. This is also why I say you have to see things again and again and again. This is why in the room we do a daily market preview, or in the members area we do a daily market preview every day, where I go through these steps day after day after day, because like we talked about in one of the first videos, when I gave that reference on landing a plane and when I learned to fly a plane and land in a crosswind, you know what to do. It's just doing it in real time with all that pressure, with the instructor in the right seat, and you don't want him to take the controls because you want to do it on your own, but you don't want to die. There's a lot to that process, and you need to see it done again and again and again. But the second aspect with that is you can't learn to fly a plane with a course. You can't learn to trade Forex with a course or just some simple video or text. You then need the second aspect. Literally every complicated profession you'll ever think of has an education phase, and then it has a hands-on training phase. You're gonna let a surgeon operate on you if he went to school for 10 years, he learned every possible thing he could about this one strategy, but he never stepped foot in an operating room. You gonna let him operate on you? I think not. Same principle here with Forex, guys. Learning it is great. Then you need to learn how to apply it in real time. And that's why I encourage you to find, whether it's this strategy or not, find an education that teaches you not just a course. You need somebody showing you how to apply that course and the rules in that course in real time. If they're not, again, they're probably not showing you that live because they're not profitable or they're not a real trader. So keep that in mind, guys, and don't, well, it's another subject. We'll get onto that some other day. Okay, candle math is so simple if taught right. Yeah, it's very true. It is. You can cut literally years off the learning process. I talk about a guy named Tim. I don't know if I'd be a profitable trader. I met a guy named Tim about a decade ago in the Forex Diamonds room. It was, if you guys have all heard of Forex Peace Army, I'm guessing. And Forex Diamonds was one of the first Forex rooms that was really popular in the retail market. And that guy he trades 1 hour trend line strategy, so I don't really believe in the strategy. It's not something I trade, but he taught me so much about reward to risk ratios, patience, discipline, and those are the things that I credit for making me a profitable trader. I do credit the strategy a bit, but if you don't have discipline, patience, money management, the strategy you trade is irrelevant. It has really no effect on your profitability. Okay. Candle count. Let's get into candle count, because you can't, when you come into a manipulation point, we have a certain number of candles that we will use to say this is still valid or it's not. Now, one simple rule, and again, I encourage you guys to write down rules, come back to it, add to it, watch the video again and see what you missed. The one basic rule we have for determining whether a level is still holding or not is once two candles consecutively open and close beyond the manipulation point, the trade would get tossed. So this is a little bit separate subject, but I realized it after I drew all this out. So I just want to share this with you guys real quick. What that would look like, it could look many different ways, but maybe it looks like that. But the point is two candles that consecutively open and close beyond the manipulation point. So open, close, I don't care what the wick's doing. The wick can be below that on both of them. It's not really relevant to me. It's all about the close. That's how I invalidate a level. That's when the level goes bye-bye. No more level here at this point. All right? So that was just a side subject I wanted to cover because that's important for this strategy. And some of you guys are members, some of you guys aren't. So if you're going to trade it, you need to at least have some of the basics. Candle count, though. Let's get into candle count. The candle count starts with the first candle that breaks the level. And by the way, I'm going to show you live examples here in about 5 minutes. Recent examples, last couple days, setups that we've had. So the first thing we look at is the first candle in that count. It starts once you get the 3-pip break, as I just mentioned. So this right here would be what I would term as the number 1 candle in the count. Now, we have something we term as the resetting of the count, or candle count. Part of that candle count is resetting of the candle count, meaning just because it started as the number 1 candle doesn't mean it's going to be the final number 1 candle. For each candle that progressively sets a higher candle body low, and there's no easy way to say that. You're saying high and low in the same sentence. It sounds ass backwards, but there's not really another way to say that. So when the next candle produces a higher candle body low, in other words, the candle body is higher, the low of that candle body is higher than the previous candle body low. When you create a higher candle body low, that resets the count. The count can be reset until you have a confirming candle. If you had a confirming candle after this, it would lock in the count. Then if it rose up again, you could not reset the count again. So the next candle, it sets a higher candle body low. It resets the count. It becomes the new number 1 candle. This is a little bit of an exaggeration, but I exaggerate so you guys can see the point. Typically not going to work out like that. You don't see it sequence 1, 1, 1. It just typically doesn't happen. It will from time to time. It's just not super common. The next candle, what does it do? It creates a higher candle body low. It resets the count. The low of that candle body, you're probably asking why that's important. Well, think back to the confirming candle rules. We have a rule that says it needs to close below the body of the previous candle. So the low of the previous candle, to me, the low of the candle body, the previous candle body, is important to me for that aspect. So each time we're stepping up, we are resetting the count. This could be the new number 1 candle. Now, let me show you a little bit of a reset where it goes 1, 2, 1. And that would look something like this. Whoops. It's going to get a little complicated here. Now we got to invalidate the setup because that would be a confirmation. So I'll invalidate it. Now it's not closing and it's lower 1/3, so that's not a valid confirmation. So at that point, what you'd have is you'd have a number 2 candle. So then, in order to get a reset, the next one could technically confirm down. That's a possibility. You could get a confirmation off that, but what we're walking through here is we're walking through kind of an extended version of this whole process. So I'm dragging it out longer than you probably would see. So what we have here is, let's say the second candle comes up and then you get another candle here. So what you'd have is you'd have candle number 3, but then this one right here would reset the count. Why would that reset the count? Well, that resets the count because it produces a higher candle body low as compared to the highest low at this point. Right now, that is the highest candle body low. Does that make a higher low? No, it's lower. Does that make a higher low? Nope, it's lower. That one does. So you'll notice how each of these black lines is stepping up as I'm drawing it at the bottom of that candle body, and that's resetting the count. Now, this process can't continue indefinitely. It can't continue indefinitely because you're going to blow through and then maybe 2 candles consecutively open and close, or, as maybe we draw out here, you have this candle over here, which produces a confirmation, and at that point, now you have candle number 2, which is a valid confirming candle, right? So now you have a valid entry off of that, and stop loss goes 5 pips above the high. 5 pips above the high of the stop run, the candle that produced the highest stop run at this point. This is just a quick overview of candle count, guys. I would encourage you to ask questions. I'd encourage you to shoot me an email, ask questions, cover this video a few times. I don't think I had anything else here. Let's see. We might go to the chart after this. No, I don't think so. All right, any questions you want me to cover? See a bunch of comments, but no questions. If there are any questions, I might have missed one. Do you enter before that bearish? Oh, here's a question. Did you enter before that bearish bar closed? No, so the confirming candle needs to be closed because we don't know where this thing is going to close, right? It could rally down, and then in the last 10 seconds, it could shoot back up and close right here and be all wick. So we let the confirming candle close, and then on the next candle, on the pullback, we take the entry when it gets to within 15 pips of the stop run high. Okay. When do you ask questions? Yeah, if you got them, feel free to shoot. Okay, let's go into, and I haven't done this, so it's going to be a little experiment going over the computer. Let's see if this works. All right, let's try this. Do you guys still have, if you can help me out and let me know if you can still see the screen, that would be awesome. I would appreciate it. And what we'll do here is, we'll walk through just a few entries. So number one, what I'll start with is, and you guys still have sound, right? All good? Okay, cool. So we'll start with here, let's just go with the, let's say euro dollar. And the euro here was one of our pre-selected points. Let's start with the level selection process. I'm going to go out to a 4-hour chart. I'm only going out to a 4-hour chart, even you can go to an hourly. I'm just going out to a wider time frame chart to show you what else is around, what else was around that level. So this was the manipulation point that we had selected. I'll walk through some basics here. So why did we select this manipulation point? Maybe it'll help if I go out to the 4-hour chart. So I had this high selected, and I will zoom in closer here in just a second. Just bear with me here for a second. I had this high selected because there is no other level back here. So to me, anybody that was long, or sorry, anybody that was short through this entire rise, the one thing that I can say for certain is if this high goes, they're underwater. Anytime I have a high or a low that puts a good chunk of the market underwater, which I'm going to give you plenty more examples here in just a second, that's always going to be a point where I'm expecting there to be liquidity. So then all of that confirmation stuff I talked about goes off the 15-minute chart. Yeah, I can walk through that. It'd just be like a 10-hour video. So the actual course is 13 videos, and it's spread out over, I think, 9 hours. So to try to do that on Facebook or YouTube, where I keep everything in my head at the time, that's why it's kind of hard to do. As far as that goes. But that's kind of the point of this video series. I'm trying to do that for those of you guys that are not members of the service. I want to give you some insight so you can start making some progress in your trading. So going back to that level here, here's what it looks like on the 15-minute chart. Remember, this is where it formed. I don't know where our arrow went. But the bottom line is that's where it was formed. As I illustrated in the second video, I'd go as close to that candle body as I can without going into it. And then I look for the stop run. Did we get a stop run here? No, you didn't have a break by 3 pips. So until we break by 3 pips, and this is another beautiful aspect of the strategy, you can set up alerts and there's no need to stare at the chart. It's one of the biggest benefits to the strategy that for somebody that works full time, which I would encourage while learning to trade. And it allows you to to not have to sit there and stare at the chart all day long. So we come back through, and finally on the 17th, we actually get the break of that level. So we start with the mechanics we just walked through. Number one, do you get a 3-pip break of that level? This is, again, the euro-dollar 15-minute chart, April 17th. The end of this box is the European session, by the way, guys. So this was coming into this high right around 4:30 a.m. Eastern time. This, by the way, this block is New York. Just for reference, the bigger, wider blocks are Asia, 5 p.m. to 2 a.m. The smaller, skinnier blocks are from 8 a.m. Eastern to noon, 12:30, right around there. So anyways, comes into the level, creates the break, breaks by over 3 pips. We get a break of that level, that initiates the stop run. The following candle produces the confirmation to the downside. That confirmation has 2 rules. Does it, number 1, close below the body of the previous candle? Yes. Number 2, does this candle, and you guys can see my cursor, I hope. Number 2, does it close in the lower 1/3? Well, if you measure that, it very clearly does close in that lower 1/3. You have a beautiful entry at that point, runs off. It's a relatively low stress trade. This was, 2 days back. We go over to the euro yen. It was a very similar situation on the euro yen. We had another nice, beautiful setup from this. Great level. The level was 126.77, I believe. Let me zoom out to show you why it was a solid level. Major overall high is essentially what we were working off of. This high here, which pretty much correlates to the previous highs, anybody short through this range, now I'm not expecting there to be a lot of liquidity coming from down here. It's not really what I care about. I don't care where it comes from. I just know this overall high, anybody on the short side of the market is underwater should that high start to go. Anybody that is short, should that high start to go, is underwater. It also makes for a good breakout point to the upside. So when you have these levels that are, there's nothing else around it, you got to put yourself in the perspective of, really the main thing we're looking at is all this trading that occurred for multiple days through here, right? All this trading that occurs through this period of time, that's probably the majority of the liquidity that's getting stopped out or that's getting induced by that false break of that level. But anybody short through this price action, that high is really the last high you have to choose from. Nothing is more pervasive, nothing is more used, nothing is more focused on than previous turning points in the market. That's why they attract liquidity so well, but you need to know which ones to go to. This is a great example of one to go to because there's not another choice beyond it. If there's not another choice, then anybody on the short side of the market, this becomes a damn good location for stops to be placed beyond, and it becomes a prime location for the market to come up, create the false break into that level before ejecting back out the other way. We use what we term as a confirming entry, as we've discussed many times here today. So on the 17th, same situation, comes in, breaks, the next candle resets the count and becomes the new #1 candle because it creates a higher candle body low. The following candle confirms down, produces a valid confirmation. We were already well within the entry zone at that point. The high, you got back to within 7 pips of the high, so you were well within the entry zone. Technically on this, I'm not going to overcomplicate things, but if you guys are a member and you're following the daily market preview, you'll know we had a 16 pip stop max on the euro yen. There's other ways we decrease and increase stop size, but it's just too hard to cover in one simple video, guys. So really nice setup there. I mean, the dollar CAD had a couple beautiful setups here. The dollar CAD, same exact principle. Let's go out to the hourly or the 4-hour chart just to show you the wider range. And I'm not picking the 4-hour because the 4-hour special or anything like that. I'm just zooming out to show you some wider levels. By the way, guys, the 4 levels you see here are 4 levels I had from the daily market preview for a couple days in a row, actually, because not a whole lot changed as we sat in this range. But on the, I think it was the 16th, so the day before a couple of those other setups, and actually let me illustrate the level. The level we were working from specifically that got the setup was this high here. Same exact principle as every other one. Anybody short through this range, the one thing I can say for certain is if that high goes, they're underwater. So anytime I have an area that puts one side of the market underwater, that's always going to be a manipulation point for me. I shouldn't say always, but the vast majority of the time, that's going to be a manipulation point for me. Now let's go into the 15-minute chart so we can see the actual stop run itself. The stop run started on the 16th or initiated on the 16th. Came into the level, created the break. The next candle resets the count. Next candle confirms down. That closed in the lower 1/3 by about 1/10 of a pip. So it closed in the lower 1/3 at that point and provided the pullback. Beautiful entry. Same situation here at the lows. We had this beautiful stop run of the lows. I did not get this entry. 32.87 was the level. That was another level. These were pre-selected like days in advance. I'm not exaggerating when I say days. I mean, these levels sat there for days. So you knew the level days in advance, comes down, gets the stop run, confirms up. But the unfortunate part about this setup, which is why I missed it personally, is that you only pulled back to about 15 and 8/10 away from the low. I was looking for the bid price to hit 15 pips from the low as we do with a standard entry. I missed it, unfortunately, by a few tenths of a pip, and it ran off. The other factor here, well, that's kind of a little bit more complicated aspect of the discussion. But anyways, hopefully this walks through it, guys. It walks through some of the basics for you. Now, if you have any questions, I'd be happy to field any questions as they come in. The comments are a little bit delayed, but I'll probably get back in front of the whiteboard if there are any questions that you guys would like to walk through. Life, for the comment from YouTube, in regards to the question of can you walk through this full analysis A to Z, if you're interested in learning this strategy, obviously there's a ton of free information on YouTube. There's the bank trading course actually on the site, and all the continuing education that comes with that. There's a lot of avenues you can hit. And then also, you're always welcome to shoot me an email, support@daytradingforexlive.com. Happy to get back with any of you guys on that, give you a little more analysis as to what we're doing here and what we're looking at moving forward. But one of the final points I'd make is that whenever you're in the process of learning, whatever strategy you choose to learn, guys, a course is not going to be enough. And I'm saying that after 14 years of trading, having run Day Trading Forex Live for the better part of a decade, probably having spoken to over 100,000 traders, 5,000 alone being members of Day Trading Forex Live. You're not going to learn it overnight, and you're not going to learn it with just a course. Whatever strategy you guys decide to learn, make sure there's a really well-detailed course. But number two, if the educator is not willing to prove that what he or she is doing, if they're not willing to prove that live, if they're not willing to get on the mic in advance and say, this is my trade, then there's a reason they're doing that. 99 or probably 95% of educators in this market are not traders. You need to be careful. It's two very simple rules. Check the reviews, make sure they do it live. If they don't do both of those things well, there's probably some issues with that educator. So I say that because not all you guys are going to like this strategy. You're going to like other things. Not all you guys are going to like me. You might think you don't want to look at my face. I don't know what it is. But the point being is you got to have an education that has the application phase. Somebody showing you how to take what's in the course and apply it to the market. All right, let's see here. Using the 200, so a couple questions came in. Yeah, I'm happy to help. Glad you're enjoying the information, Life. Let's see here. Are you using the 200 moving average as the first line of support and resistance, or just a direction of the market? So the way I use that, and I'd encourage you to go back to the last video we did on the selection of manipulation points, because remember, you got to select the manipulation point first, and then you wait for the stop run of that point, right? So if you're getting the stop run of that point, and I'll turn back around here and talk to you guys. But if you're getting, or number one, you've selected the manipulation point, that's where it starts. That's why I said go back to that video. But the 200 moving average, and I use the EMA versus the SMA. I know the SMA is more well used. If you look at different TV programs and they're pulling up stocks, a lot of times you'll see the 200 SMA. I know that, but I prefer the EMA. That's just based on my decade of trading, my personal experience. I'm not saying like I have all this experience. I'm saying based on my time trading, that's what I've found to be the most accurate. The EMA puts more weight on the more recent price action. That's why it always made sense to me. But I don't use it as a directional bias. I use it as a supporting factor for this. So if I've identified, the way that comes up in a real world situation is maybe you have a weaker manipulation point, right? Maybe for some reason or another, it's a weaker level. And you're going back and forth on whether or not you should choose that level as a manipulation point. And you're just not sure if you should choose it. There's not it's just over minimum criteria. There wasn't a huge bounce off that level, whatever it might be. But it also happens to line up with, say, the 200 EMA. So now you have a little bit of supporting factor behind this. Remember, we're looking at all these areas, whether you're talking about a major fib retracement, S1, R1, daily pivot, which is really all I'd care about for pivots. All these areas, psychological barriers, like round numbers, one's about 2,000, one's about 2,100, or yen crosses, 110, 111, 112. All those factors, what they're doing is we're just trying to use really commonly used things to identify where traders might be buying or selling. Because if you know where traders might be buying or selling, then you know where the liquidity is. If you know where the liquidity is, you know where smart money is going to go to get that liquidity. And then if you see them go actually take the liquidity with the stop run, now you have a very good indication of the next short-term direction of the market. Because if they're going to get the liquidity and they're selling into the buying pressure, the market is probably not going up. The market's more than likely going down. Now, something could change that. News could come out. Something could change that. But for the most part, you know, you're in line with the next short-term direction. And here's the thing is, you win 50% of those trades with a 2-to-1 reward risk ratio, you're going to be doing very, very well. Do you look on the daily, weekly, or monthly? For me, it's mainly daily, or it's all daily. And remember, especially for fibs and pivots, especially those two factors, there's staunch followings along those. Even among the quote-unquote professional side of trading, they're very well used. That's why they attract liquidity. But be very careful in trying to use them as a standalone manipulation point. In my opinion, nothing attracts liquidity like a previous turning point in the market. And then a previous turning point in the market that is properly identified. You know, what else is around it? Has it had a large enough bounce? Has there been enough accumulation after it formed for there to be any liquidity at that level? You know, all those are things that go into it, but it revolves around a previous turning point. Any of those other factors mentioned in the previous video on selection of manipulation points is what I term as a supporting factor. So don't use it as a standalone. Use it as something to support a level that already had a reason for being there. So, you know, wherever that market came in and then produced a 30% of the ADR run off of that level, at the very least. But again, if it's a weak level, you get a little bit of support from that. Maybe this lines up with a 61.8 on the last major move that you've had. So you get a little bit more confluence with there being a major fib retracement there. It's a point of support. It's not a standalone manipulation point. All right, how long have I been running my mouth here? Probably a while. I don't know. I'm sure the time is somewhere, but I don't know. So anyways, guys, let's see. Let's wrap this up. So I don't know how you can start motivated to help to 99. I mean, I love this business, guys. I'm 32 years old, and I've never worked for anybody in my life. You know, I'm not sitting on $10 million. I'm totally honest about that. You don't see me driving a Lambo and you know, I don't live in a mansion. The one thing I have done, though, is I'm 32 and I make a damn good living from the Forex market, and I don't work for anybody. And I work right here from my home, stay home, do whatever the heck I want, go golfing during the day. You know, when you get emails back from people where they're like, Sterling, you've changed my life. I'm 3 years into trading. There's one lady we know, probably one of our best traders. She just trades gold, but she just did over 3 mil. So when you get, you know, you get comments like that, and then number two, I don't know if I'd be profitable if it wasn't for Tim. You know, that guy had, I mean, I'm like scared to think if I would never have met that guy, because what would I be doing? I met him when I was like 19, you know, what would I be doing? The family business was blueberries or drywalling or a machine shop, all things I didn't want to do. So when I put it in that perspective, I love doing this. I mean, I love the education process. And the other thing is, trading's pretty darn boring. So to have a group of really cool guys that you can chat with, you know, you can provide feedback to, it's just kind of nice to have a community feel as well, which is what I try to do with the bank trading strategy as well as the bank trading forum, where we teach it, where the course is, where there's a live chat box. People can talk about setups. They can post in the forum. I run a live room twice a week. You see me talk for a couple hours, go over setups, take live setups if they're setting up at the time. And, you know, that community feel, it's huge for me. It's a benefit to me. I reinforce to myself day after day what it takes to be a profitable trader and what I shouldn't do. So, you know, there is a lot of benefit to the educator as well. What percentage of the time does the price break those levels compared to when they don't break? You know, I could come up with a random number here, but it would be a guess. And the reason that that doesn't matter to me at all is because when we draw a manipulation point, what we're saying, like whatever formed for us to draw the level here at whatever price point, whatever pair you want to envision here on this setup, whether this level breaks or not is not really why I had it drawn there. I had it drawn there because I expect there to be liquidity around this area. So the confirmation, and it's really important to understand, we're not saying we expect the market to turn there. If the market comes back into this, when I have a manipulation point drawn, I am in no way, shape, or form saying I expect the market to turn from that point. But what I am saying is if we see a stop run of that level, okay, now I expect it to turn the other way. A stop run followed by a confirmation to the downside. Okay, now I expect it to turn. But it's just as much an illustration of the strategy doing its job. When a level doesn't hold, it's just as much an illustration of the strategy doing its job when you don't set up. So when the market just continues to push to the upside, never producing a setup, this is exactly what you want to see. It's exactly what you want to see because if you'd have got this setup, you'd have lost, right? So that's another aspect with any entry strategy is the strategy's ability to keep you out of bad trades. It kind of goes back to, I posted a video at, hell, I don't really know where this is, but I talked about, it's the 20 trade challenge article, but I reference a video. It's called Floored. It's about a bunch of floor traders and kind of their struggles when the computers came in, how the pits have changed and all that. But one of the guys, he's retired now, and he said, you know, I never made the most amount of money. Plenty of guys made more than me. I never had the big days, but I lost less than them. And then he goes on to say, it's really not about what you make. It's about what you don't lose. And that is such an important point because it's not about necessarily just the profitable setups, getting a stop run short, long, getting a profitable setup. It's about the times that this level isn't going to hold, the times where, yeah, maybe you did identify a liquidity point, but smart money doesn't have an interest in selling from that level. Maybe they want to sell from an upper point. That's why we got to wait for that confirmation. And that's why the level breaking without producing a setup is just as much an illustration of the strategy doing its job as is a confirmation down when there's going to be a profitable setup. So hopefully that makes sense. All right, guys, I'm going to wrap it up. If you have any other questions, you can shoot me an email, support@daytradingforexlive.com, or check out the site. I got a ton of videos, articles on the site. You can check out the bank trading course, what's included in that, and whatever else you guys want to look at. There's a bunch of information. Also, if you don't see all the videos, check out YouTube, ton of information on that. And be sure to like the video, subscribe so you can see the next one. I'm not sure how these alerts go out to you guys for the next live video. This whole live process is kind of new to me, but I hope you're enjoying them. And I'll be back for the next one. I think with the next one, I'm not quite sure what I'm going to cover. So if you have any suggestions on that, I think I kind of want to get into some trade management ideas and you know, some other things along those lines that are going to be really useful. Position sizing, different things like that. So we'll be back for the next one, and hope you guys enjoyed this video. Until then, happy trading.